The market is on another incredible run where almost every single stock is green and going up every day, but we are back to SoFi just getting beaten into oblivion once again while everything else is running. Heck, even PayPal is trending green while SoFi just continues to go down and down again. But that is also the perfect setup for a huge move in SoFi stock. So let's discuss all the details today right after you like the video if you like getting the truth without the hype and video styles like this. So let's kind of sum up SoFi's ride for the past year or so. Basically, it starts on a nice run, continues to run, comes into earnings, great earnings, and the stock just craters right back down to $4 or $5. And basically starts to build itself back up, coming into earnings again, building itself up, hits earnings, great earnings, and once again it gets beaten down and kind of rinse and repeat over and over and over again, except for I've kind of noticed the cycles are actually happening faster and faster even in between earnings. We'll get nice run up to earnings, beaten down after earnings, run up again, beaten down again, run up again, beaten down, then run up into earnings. It's just the pace of everything in this particular pattern just seems to be accelerating as we kind of move forward with SoFi. So I fully expect a massive move from SoFi as this all kind of intensifies and kind of reaches its peak. But that is also where it gets very, very dangerous as an investor. But before discussing those disasters, if you want help from A to Z with SoFi stock, planning, valuation, price targets, everything else like that, the biggest discount for my group ever is live for the Black Friday sale, where you get absolutely everything you need in order to do that. You get that through 5 courses. You get that through exclusive videos. You can talk directly to me, slide into my DMs. We got a stock analyzer tool for you to use. We have the best 6, 7, and 8-figure Discord out there. There's so much in this group, guys. There's no group out there that gives you more for less. So make sure you check out the pinned comment and take advantage of the sale, because when those spots all fill up, the sale is gone and the biggest discount is gone forever. All right, so kind of back on topic here. This is absolutely dangerous for 2 reasons. The first one is I can make an incredible bull case for SoFi. In fintech, nobody has performed better than SoFi over the past year and a half or so. Nobody has. I can even make a case in regards to banking overall that nobody has performed better than SoFi during that time. Nobody has had better earnings. Nobody has exceeded expectations more. No management team has performed as well as SoFi's has during this time. Everything is going as good or better than it should, and you could not ask for anything more at this stage. There's literally nothing else SoFi could have done any better than what they already did over the past year and a half or so. But reason number 2 is even more dangerous, because I can easily make an incredible bear case for SoFi as well. Look, whether we like it or not, SoFi is not out of the woods yet. They're on their way. They're right on track. I'm not concerned, but I also can't say they're out of the woods yet. Everything's good to go. They're completely out of speculative category. They're over here in the profitability category now, because they're not. So I can't say that. And then even more dangerous than that is the question of the multiple for SoFi, because right now in fintech has a much higher multiple than banking does, but SoFi does continue to kind of creep closer and closer towards kind of a banking type stock or banking type company versus a fintech company. And there's a giant difference in the multiple paid for a banking company versus a fintech company. So kind of the best example I can give to this is kind of like a company that does software, right? That commands a much higher multiple. And then if they change and they get into the hardware business and they go full on hardware, at that stage, their multiple will come down. The multiple paid for hardware companies is significantly less than those that are software based. And that right there is kind of, fintech's kind of the software side, and traditional banking is kind of over here on the hardware side. So if SoFi isn't careful, they can get themselves into a point where they are kind of considered, and remember, it doesn't matter what me and you think, it matters what Wall Street thinks. But so they can get themselves in a scenario where if Wall Street thinks that they're a banking stock and no longer fintech, that multiple is going to come way down, which absolutely destroys the valuation and the long-term valuation for SoFi. So they've got to be careful there to make sure they stay firmly in that fintech category. So to me, the question is not if a huge move is coming. To me, the question is, which direction is it going to go? Either skyrocketing up or cratering back down and basically staying in those doldrums. The answer for right now is one thing and one thing only. We'll discuss that here in just a second. And then we'll also discuss the timing of that move, because I'm sure you guys want to know when that's going to happen as well. So we'll discuss that right after we discuss what's going to determine the move up or down. So the one thing that will determine the direction of the huge move for SoFi coming here shortly is going to be on the next earnings call. Do they actually turn the profitability knob or not? Now, if so, we all know what's going to happen. It's going to basically take the rocket ship back up again. Now, of course, that's dependent on, obviously, if it runs up to like 12 bucks ahead of earnings, then okay, maybe not at that stage. But given where it's at right now, if they're able to just kind of maintain and kind of hold right here in this range, $6, $7 range or so, and then they're able to turn that profitability knob on fourth quarter earnings, give great guidance and all that sort of stuff, it is absolutely going to send that stock on a nice big run up and a huge move up. Now, if not, all trust in management is completely gone, and the past year and a half plus of good news and management executing better than almost everyone is completely gone. So that is a risk factor there. Not necessarily what I think is going to happen. As a matter of fact, I don't think that's what's going to happen, but we have to at least acknowledge that risk. And if it does happen, yeah, you guys wanting shares in the fours, you're going to get shares in the fours if that happens. But because I don't think that's going to happen, or at least that's a very unlikely scenario, let's discuss what the actual timing will be of that run and exactly when it will happen. So I really think this is going to go one of two ways, guys. There's basically, to me, when that run happens, it's going to happen in one of two ways. One of these two is going to be the way that this stock is absolutely going to see its big move. And don't worry, we'll discuss exactly how to handle this situation because you need a plan for both, and I'm here to help you guys out. The first is that the stock kind of does what it does coming into earnings there, whether we get a little bit of a run up or not. But after earnings are announced and they're profitable there, we basically permanently pop up over that $8 mark. And if we can kind of hold that $10 line, man, we may never get down below $10 again. Now, that's not a guarantee or anything else like that, but it's very probable if we're able to get up over that line and maintain that line. Man, it could very well lay kind of like that baseline there, that baseline of support, especially as larger institutional investors who don't buy and sell as much, who want to hold the stock long term, and other funds that want to hold the stock long term start to move into the stock. And my guess is we're probably never seeing the fours again after that, unless there's a disaster or something like that happens. But beyond that, as long as management continues to execute, those days of the $4 shares are completely gone. You missed out by that stage. And the second is the stock kind of follows the Palantir pattern that we kind of got this year when Palantir turned profitable. Essentially, Wall Street will run it up after earnings, better than its run up before after earnings, just to beat it right back down again. They did the same exact thing to Palantir. They ran it up after they turned profitable the first time, ran it way up, and then they beat it back down to $7 one more time after they turned profitable. So you had one more chance to, quote unquote, buy the dip on Palantir before it finally got itself up over the $10 mark. And of course, now we're up over $20 now with that stock, and it just continues to go. So that right there is kind of the second scenario I could see playing out as we get one more chance where Wall Street kind of teases us, kind of fakes us out, beats it down. Everybody's like, gosh, what does this stock need to do to take off? And well, it was just actually a golden opportunity to add even more shares to SoFi, just like it was for Palantir to add shares one more time. I know I was very happy to get to add one more time to my Palantir position, and then obviously see it go on the rocket ship up from here. So essentially SoFi gets a run up to around $10 or so, then it gets beaten back down again to $6, $7, right around in that range, before it finally takes off again, gets up over $10. And essentially that's the last time we see it under $10 for the foreseeable future, unless something, of course, bad happens or something like that. But barring some craziness like that, as long as they continue to execute, that right there will be the last time that we see it. So how do you kind of handle this situation in these two particular scenarios? What exactly should you do in either of these scenarios? Well, obviously, as we've seen the past year, the prudent thing to do is to not get all emotional about the stock. Do not get caught up in the trading games and simply ignore those particular games and just build out your position over time. Now, I understand our time may be coming to a close in regards to super cheap shares, but that doesn't really matter in the long term. Long term, you want to have more shares because let's say SoFi is a $30 stock, $50 stock, maybe a $70 stock in your mind. Well, I would still be willing to add at $10, $12. I'm still going to be very happy if it's a $50 stock and I bought a bunch of shares at $10, right? I mean, it's still a 5x on my money during that time in a fintech stock. Still a great run in a stock. So you want to make sure that you just have a plan to build out your position. Because if it takes off and never comes back down and you're constantly waiting for it to come down, that's a disaster because it may not ever come back down, which means you don't own shares of a great stock you knew was great all the way around. So there are essentially two ways to handle this and kind of keep the emotions out of it so you completely avoid the disaster that is missing out on the stock altogether. And the first one is exactly what I use and what we teach in our group every single day, and that is a modified DCA. I know a lot of you guys are like, hey, what the heck is a modified DCA, Luke? All right, I got it, guys. Essentially, it is whenever the stock hits my price target, I go ahead and I start buying. And as the stock continues to fall, because it seems like I can never time the bottom, right? So it's going to continue to fall. I continue to add shares on the way down, getting heavier and heavier the lower and lower it gets. And then obviously as it creeps its way back up, add until it hits my price target, and then I stop and I lay off there. Nobody can time the market. Nobody knows where it's going. So I simply do a valuation, give myself a price target, wait until it hits that, and then I start buying my shares. And I just simply let the valuation and my price target tell me exactly what to do and exactly when to start and stop my DCA, which of course over the past year plus here with SoFi, it's been very, very clear. Hey, it gets up above my price target, I stop buying. It gets down below my price target, I buy. It wants to go down to $4, I buy even heavier, rinse and repeat over and over and over again to where I'm well into bonus shares now with SoFi, which is awesome. It's great to be able to just add shares and feel confident that if it runs up ahead of next earnings and then they have a great earnings and then it goes to the moon after that, I've already filled out my entire position. That right there is what that strategy gives you in terms of time. Now, on the flip side of that, I understand that not everybody's comfortable with that. Not everybody, necessarily has the time or the energy or the skill set to maybe feel confident setting price targets and getting valuations and stuff like that. Got a lot of new investors right there. That's okay too. That right there is where method number 2 comes into play. And that is just simply execute a DCA. Basically put it on a schedule and buy SoFi stock, regardless of what the price is. Price is $4, price is $8, freaking buy the stock once a week, allocate X amount of dollars to it and buy it. You want to do it once a week, once a paycheck, whatever the case is. Simply execute a DCA is one of the best ways of building out a position in a stock and removing emotion from that, equation per se, to where you are more focused on share count and just getting your position bought out than you are actually trying to figure out what my average is and let me get in at this price and get in at that price and get caught up in all those other games that stress you out, are really, really hard to do, and put you right squarely into the scope of Wall Street and the media and YouTube and everybody else's kind of fangs per se, to kind of get you all emotional and all over the place. A DCA eliminates all of that. Nobody can time the market. I most certainly can't. Nobody else out there can either. All the great investors say you can't. So just executing a DCA is the best way to keep emotions out and to ensure that you own shares of a stock before it absolutely does take off on a rocket ship and has that big move. And remember, the biggest sale for my group is live now, where the biggest discount ever is being offered, where you get 5 courses for free. You get to see all my buy and sell alerts in real time, see my watch list complete with price targets. You get to take 5 courses for free, use our stock analyzer tool for free, be a part of the best 6, 7, and 8-figure Discord out there. We go live all the time. You guys can slide into my DMs, ask me questions in our Discord. There's just so much there, guys. Make sure you check out the pinned comment and take advantage of the sale before the sale ends forever. And click this video here if you want to see exactly what I'm buying in this market, and click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.